Three big developments in the global markets today, and these could shape the stock market action in days to come. Let's begin first with the United Kingdom. In Britain, inflation has softened to 10.5% in the month of December, which means it's down from 10.7% that was reported in November. The inflation touched a 41-year high. 11.1% is the number that was reported in October last year. And of course, it must be pointed out that fuel costs have eased, but food prices remain sticky. They continue to soar, and in what should really come as relief to investors is the wholesale price inflation measured in the US through the producer price index. Now that has fallen in the US to 6.2% in the month of December. In November, it was 7.3%. Sixth month now of prices cooling off. And yes, there is action in Asia as well. The big Q coming in from the Bank of Japan, which has kept the bond yield curve unchanged. It gives a push to the stocks on Asian bourses, but the yen, the currency, has taken a hit. So the big question now is a reprieve from rate hikes almost certain because inflation is bending to the will of federal banks? And what can the markets expect in the weeks to come? That's the big question. Let's find out what the experts think. Manish Singh is Chief Investment Officer at Crossbridge Capital. He's joining us on the show with Anurag Singh, the Managing Partner at Ansett Capital. Great to have you with us, gentlemen. Anurag, while the UK inflation, we are seeing it soften, but its food inflation still uncomfortably high. Fuel costs, of course, have seen some amount of easing. Do you see inflation that touched that 41-year high going over 11% in October last year, now trending down further? Or will this ongoing Russia-Ukraine war put a spanner in the works? And really, the question is, does this British inflation number ease some of the pressure on the European bourses, at least at this time?
So, Vikram, it is kind of a similar problem. We can draw parallels to what's happening in US as well. UK is facing a very similar situation, right? If you look at unemployment, it hovers, and I'm sure Manish can speak a little more depth about the same as well. But unemployment about 3.7%. Politician taking the cover that wages inflation is actually not keeping pace with the real inflation. There is some moderation that we see because of lowering energy prices. But at the heart, inflation, which started off as a monetary phenomena, which is more money supply, and then which pulls the demand forward and then creates this crunch. I think it will only go once there is at least a shallow recession, and once the employment market comes into balance with the larger economy. 3.7% unemployment, I think it is too low, and that's where the wages begin to catch up, and then they begin to lead the inflation. So I think we should not read too much into this moderation from 10.9 to 10.7 to 10.5. That will continue to happen, but I think it will drop to a point, maybe 7-8%, and where it will get stuck. And that's when the wages will have to give way, and it will not go before that. That's a high-level view, but I'm sure Manish can add more color to it.
What's your perspective? Because like we are hearing right now, as far as Anurag is concerned, he believes that we need a shallow recession in Britain before we see some amount of stability come in. But how do you see recession play out? Of course, as far as Britain is concerned, we have been talking about it for some time, but how severe is it? Can we expect a softer landing at least than what was expected looking at the print now on inflation?
Well, Vikram, that's what we will hope for, soft landing, right? Because that's what we are hoping everywhere. But just a couple of seconds on inflation. The inflation will really start coming down, and not just in the UK and other places, is from March and April onwards. Because if you look at the month-on-month number, and that's the key. So the month-on-month number for December was 0.4. But if you look at the month-of-month number in March of last year, April of last year was 1.1, 2.5. Those big things have to drop out. And remember, inflation is a measure, right? Annual measure. So when these big prints drop out, then inflation starts dropping. But having said that, if your month-on-month is still at 0.4, and compare this to the US where it is minus 0.1. So in the US, if you look at last 6 months, inflation is trending at 1.8%, which is well within the target of below the Fed target. In the UK, it's not the same, because if you look at 0.4, and I'm looking at last 5-6 months trend, it's 0.4, 0.4, 0.5. So you're still talking about 6.5% inflation, which is high compared to what you're saying. But then again, it just shows the different nature, that in US you have energy independent US. In UK, we are not energy independent. We have to import energy, and that plays an important part. So inflation is coming down. Inflation will start dropping a lot from March or April onward. This is across the board. You're going to see everywhere. Whether we have a recession or not, that will depend a lot on consumption. So far, I think that because the consumers have saved a lot of money during COVID time, it's still looking okay. But if the rates were to remain high for, let's say, 2 quarter, 3 quarter, then of course it starts playing into the consumer sentiments. So soft landing is what we hope for, but inflation will come down very quickly. You will see from Q2 and Q3 onwards.
All right, so that's sounding good on British inflation, at least for the moment. But of course, like Manish is pointing out, Anurag, things are much better over in the US when it comes to price control. The prices seem to be trending down more definitively in the US. The producer price index is pointing towards that. The latest print, now over 6 months consistently, we've seen these prices come down. So is the reprieve in rate hikes in February looking that much more certain in your opinion? Do you think the Fed is going to go with 25 bips, or do you think it'll go ahead with 50 bips? What's the sense in the markets? What are expectations now on the back of these inflation numbers?
So, Vikram, there is a reason why they say inflation is the genie. Once you let it out of the bottle, then the way to get it back is kind of very tough, and there's no direct formula to it. I think Chair Powell has made it very clear that he will probably go with 50 basis point in the upcoming meeting in Feb. And I think eventually then in the subsequent meeting in March, they might do another 25 or 50. So the terminal rate is going to be, for now, it's priced in that maybe 5 to 5.25% will be the terminal Fed funds rate. They're at 4.25 today. So the range is 4.25 to 4.5. But Vikram, that's a given. And they've said they want to go there and pause, because this is a significantly higher rate compared to, the economy has been on pretty much zero for the last 14 years, right? So you can understand how 5% also can be a very high interest rate to bear, right? But then this higher for longer narrative, how it plays out, Vikram, we'll have to see. And that's where this whole inflation becomes more of a psychological phenomena, Vikram, rather than a monetary phenomena. It starts off as a monetary phenomena, but now wages have really caught up and they want to shoot ahead. Corporates don't want to take a cut. They want to give the wages and they want to pass it on to the consumers. And this spiral goes on until there is a downturn in the economy. That's where I stand, Vikram. But I think majority view currently is that Fed might just pull a soft landing. But then, if most of the consensus is on one side of the aisle, I think most of the times that doesn't turn out to be correct. At least that's what the history suggests. I'm just not being contrarian for the sake of contrarian, but I'm saying that inflation is now built into the wages and it will not go away without a significant recession, at least in US, and I believe it's the same phenomenon in UK.
Yes, fair enough. And important it is to play the devil's advocate, even as we see these reassuring numbers on the inflation print. But yes, I'm looking at how the markets are doing over on Wall Street. They are making a move towards the green after the kind of earnings season depression that we saw, the sellout. But now the Dow Jones is up around 0.25%, 0.75% up on the NASDAQ, and right now about 0.5 percentage point up on the S&P as well. But yes, even as the impact of all the action that we are seeing on British and American inflation are getting played out in the markets, besides those cues for the global markets, there's the Asian influence as well, Manish. And it comes in a big way from Japan. While central banks have, of course, the right to choose their path, the Bank of Japan's stance on interest rates, keeping them at ultra-low levels of a negative 0.1%, stands so much in contrast to how central banks around the world have tackled rising prices. Do you get a sense of what has worked out better so far, working on inflation or keeping the focus on shaking off stagnant growth? Do you get a sense of what is a better approach, or is it really too early to tell, going by what Bank of Japan has consistently done so far?
Yeah, so if you look at this was Governor Kuroda's last meeting, and the yield curve control target that he set of 50 basis point, the bond yields are there already. And if you want to see where the bond yields are headed, look at the interest rate swap market. There it is already at 1%. So it clearly signals that this 50 basis point control is not going to last for long. But having said that, what does it mean if the yield control was to let go? What you are really seeing is, if you see the spread differential between JGB, this is Japanese government bond, and US Treasury, that has fallen from 400 basis point, 4% to 3%, and it could fall more. This will lead to a huge amount of repatriation of capital. As you have seen if you look at the dollar JPY curve, it's very straightforward. That chart over the last 35 years is that you have mean reversion, a very aggressive mean reversion, which takes you beyond certain limits. So you will see yen going from 80 to 130, back to 80. And I mean, recent phenomena, you saw it went to 150. In my opinion, it is probably going down to 112, though it's at 130 at this time. What does this mean? People will suddenly find the Japanese equity market, which trades at a lower PE compared to others, more attractive. So the impact of this is going to be in terms of reallocation of capital. I do not think that this is going to be cause a huge amount of volatility in the market unless you are trading these rates and you are levered on this carry trade. Then of course you have to face the music. But other than that, I think it's going to be a huge amount of reallocation of capital, the weakness of dollar. But one thing I would like to mention at outset, most of the time you see these things are very well coordinated. Why are you seeing these moves from Bank of Japan now and not when the Fed was raising rates? I think without going into conspiracy theory, I think when you look between Japan and the US, it is always very well coordinated. So I do not think that this will lead to some sort of measure where there will be a buyer strike on US Treasury. I think those are just too far-fetched things to talk about. There'll be reallocation of capital. There's money to be made if you're shorting Japanese yen, if you're buying Japanese equities. But you see this more as an allocation play. And if this leads to a bounce in economic activity in Japan. Remember, in Japan, the inflation now is at around 4%, at least if you look at the prices. This is the highest since 1982. So if you have Japanese economy come back into play, then investors have one other asset market where they want to invest. This should be seen as a welcome move in terms of where you're going to make investment rather than everyone long dollar, long US equities. So it should be seen in that context. It may not be a bad thing.
Variety is always good, and you need to not put your eggs in one basket, and perhaps this gives you an opportunity. And of course, like you said, this is away from any kind of conspiracy theories that may be doing the rounds. But of course, these three big triggers in the markets: inflation in the US, inflation in the UK, and of course, the Bank of Japan's decision to keep those interest rates at ultra-low levels. We'll keep tracking those, how they play out in the markets. But thanks very much for joining us with your perspective.
Thank you,
Manish
Vikram.
and Anurag. Always a pleasure getting your perspective. Thanks very much. Let's tell you what happened.